Good day, all of you. So, today we will discuss CMA final corporate financial reporting paper 17, I think. As discussed in previous class, we started with accounting standard 13, accounting for investments. So, the next standard is AS 14, accounting for amalgamation. This accounting for amalgamation or consolidated financial statement, that is AS 21 or AS 23 investment in associates, all these accounting standards is directly related to amalgamation, restructuring, consolidated financial statement topic. Okay, so what I plan is I will discuss that along with the relevant chapters. So as we discussed, as I said already, that I will focus more on accounting standard, which is there only in final level. So intermediate level, whatever the accounting standard you already prepared, if time permits, we will discuss later. So if you go through the next accounting standard which I am going to teach is accounting standard 20, AS 20, earning per share. Okay. So this earning per share. What is this earning per share? Actually, AS 20, you know accounting standard. What is this earnings per share actually? Share means what? Whether it is an it may be equity shares or preference shares, but generally, what is the meaning of earning per shares? What is that earnings? So AS 13, sorry, AS 20, as per AS 20. All the listed companies has to disclose the earning per share, and also the as per schedule 3 of the Companies Act 2013. If you go through the schedule balance sheet and P&L, one of the factor is EPS as well as diluted EPS. So that is basic EPS and diluted EPS. That means indirectly or directly all the companies needs to follow this EPS actually. So we have to understand what is EPS, that is earning per share. What is earning actually as per AS 20? What is earning? To whom it is? This earning is available to whom? All those things we have to understand first. And the objective of this AS 20 is how to calculate that EPS, computation of EPS. What is earnings as per AS 20? Okay, what is share as per AS 20? To whom you have to present? How to present? Where to present? Okay, all these things is defined in AS 20. So the objective of AS 20 is computation, presentation, and also disclosure of things related to AS 20. Okay, this is what we are going to learn. So we'll move to the topic directly. So AS 20 earnings per share. So as per the things, earnings means what? Earnings is generally it is called basic earnings per share. Okay, earnings per share is nothing but basic earnings per share. What is that basic earnings per share? Basic earnings per share is equal to basic earnings divided by weighted average number of equity shares. Okay, so now you can link the earnings is an earnings available to equity shareholders. Okay, so generally in our P&L account, what we will do? P&L account, first we have to debit all the expenses, and finally we have to provide taxation, and thereafter you have to arrive the net profit. After net profit, you have to do some adjustment for extraordinary items. Remember your schedule 3. I am just linking with your schedule 3. So we have to do adjustment for extraordinary items. Thereafter, if any dividend is payable to preference shareholders, also we need to consider, that also we need to deduct. So after paying dividend to preference shareholder, what is left out? What is left out is only available to equity shareholders. Fine, because preference shareholder is always having advantages over dividend. So we have to pay fixed dividend. In case of cumulative preference shares, we need to pay the fixed dividend. Correct. So earnings means, basic earning means earnings available to equity shareholders. Earnings available to equity shareholders. So that earnings will be arrived after adjusting all the expenses, even interest. Interest is also one of the expenses. So the next thing is basic earnings. Basic earnings is the amount of net profit after tax belongs to equity shareholders, which will be calculated as follows. So what they are saying, basic earning is the amount of net profit after tax belongs to equity shareholders. So P&L account, imagine your P&L account, you have income, expenses, net profit, then provide tax, then you will get after tax figure. On that, if any dividend payable to preference shareholders, okay, that also you pay it. After that, what is available, that is available to equity shareholders, okay, which is calculated like this. So basic earnings equal to net profit after tax, which includes extraordinary item minus preference dividend on cumulative preference shares plus tax on preference dividend. So what they are saying, when I pay dividend to the preference shareholders, I need to pay tax also, dividend tax. That also I have to deduct from my profits. Correct. So net profit is an profit after tax minus anything is payable as a dividend to preference shareholder on cumulative basis minus preference dividend on non-cumulative preference shares only if dividend is declared. What is the difference between non-cumulative and cumulative? Cumulative means we have to pay definitely the dividend, correct? It is a cumulative in nature. Non-cumulative only if they declare the dividend, then only we have to pay. Otherwise, we need not to provide anything for dividend, correct? So this is basic earnings. So why we are discussing this basic earnings? We have to understand earning per share. Earning per share is how much equity shareholder, how much they are earning per share. That is what earning per share, okay? That is belongs to equity shareholders. So what is the next? So the next thing is basic earnings calculation example. Just small example for basic earnings. So why we are directly discussing the formula? Because we have to calculate earning per share. That is the objective of this standard actually. We have to identify what is earning per share. That is why I directly went for explaining the formula. Okay. So example, X Limited makes profit before tax 10 lakh rupees. There is a company called X Limited. They made a profit of 10 lakh rupees. Tax rate is 30%, and they have 5% 1 lakh cumulative preference shares at rupees 10 each. Calculate basic earnings available to equity shareholders. This is the question. So first step, what we have to do, profit before tax is given in the question, that is 10 lakh rupees, correct? On this we have to deduct the profit. Sorry, on this we have to deduct the tax first. Because this is profit before tax, we have to make it after tax. Because earnings available to equity shareholder is the final figure, which is after providing tax, after paying dividend to preference shareholder, whatever is left out, that is available to equity shareholder. Okay. So profit before tax 10 lakh into tax rate 30%. Tax rate 30%. Tax rate at 30% equal to 10 lakh into 30% equal to 3 lakh rupees. Okay. Then profit after tax you will get it. Profit after tax is 10 lakh minus 3 lakh equal to 7 lakh. Okay. So profit after tax is arrived. What I have to do it? Whether in question you have a cumulative preference shares. So if anything is payable to dividend, that also you pay it. if anything is payable to preference shareholders, that also you pay it. Then only balance is available to equity shareholders. Okay. So the 1 lakh cumulative preference shares at rupees 10 each. So 1 lakh into 10, how much? 10 lakh rupees. 1 lakh shares into 10 rupees is equal to 10 lakh rupees. 10 lakh into 5%, how much? 10 lakh into 5%, how much? 50,000 rupees. So that's what arrived here. Preference shares dividend equal to 50,000 rupees. So how it is arrived? 1 lakh shares into 10 rupees equal to 10 lakh rupees. 10 lakh into 5%. 5% means dividend rate actually. 10 lakh into 5% equal to 50,000 rupees. That is preference shares dividend. Okay. So profit after tax is arrived and dividend is paid. Preference shares dividend is paid. So what is balance? That is basic earnings available to equity shareholders. Okay. That is called basic earnings available to equity shareholders. Then why we are calculating this one? What is the purpose of calculating this for this basic earnings? Because we have to know our earning per share. Earning per share formula is basic earnings divided by weighted average number of equity shares. Basic earnings divided by weighted average number of equity shares or number of equity shares. It depends on the form, depends on the question. Okay. So basic earnings is identified. So the next thing is weighted average number of equity shares. What is this weighted average number of equity shares? Why we are providing weight actually? What is generally number of equity shares? Number of equity shares means equity shares held during the period. That is number of equity shares. Then why weighted average number of equity shares? What is the reason? So first you have to understand the formula. Formula is, what is the formula actually? Formula is what actually? Formula is for identifying the basic earning per share equal to basic earnings just now we understood divided by weighted average number of equity share will give you basic earning per share. Okay. So we understood what is basic earnings. Now we are going to focus on weighted average number of equity shares. Say for example in this problem itself, next problem. So in this problem, what is the basic earnings you have actually? What is the basic earnings you have? 6,50,000 rupees. 6,50,000 rupees is the basic earnings, correct? Assume that in this problem number of equity shareholders is 1 lakh. Assume in this problem the number of equity shareholders is how much? 1 lakh rupees. Then what will be your basic earning per share? Assume in this problem number of equity shareholder is 1 lakh. Then what will be your basic earning per share? What is your basic earning per share formula? Basic earnings per share formula is so in that problem basic earnings equal to 6,50,000, correct? In the same problem, assume number of equity shares. Number of equity shares is 1 lakh. Okay. Then what is the formula for basic earning per share? Basic earning per share is nothing but basic earnings divided by weighted average number of equity shares. Okay. So 6,50,000 divided by 1 lakh equal to rupees 6.5 per share. That is my basic EPS. Okay. So here the number of equity shares is 1 lakh and basic earnings is 6 lakh 50. So 6 lakh 50,000 divided by 1 lakh equal to 6.5 per share. Okay. Then what is weighted average number of equity shares, sir? You said number of equity shares is 1 lakh rupees. Sorry, 1 lakh. So then what is the weighted average number of equity shares? What will happen in practical scenario normally when a company is running their business? Sometimes during the year they will issue new shares. Sometimes what they will do during the year, they will issue additional shares. Sometimes during the year they will do buyback of shares, correct? Buyback means buying back the shares, correct? So in such a case what is happening? Say for example, one shareholder is invested at the beginning of the year. One shareholder is invested at the beginning of the year. One share, and after 6 months again the company is issuing new shares. After 6 months again the company is issuing new shares. So here what happens? One shareholder is already invested from the beginning of the year. Another shareholder is invested after 6 months only. Another shareholder is invested after 6 months only. So in such case what is happening? One shareholder is invested from the beginning of the year means he is eligible for full profit. He is eligible for full profit, meaning he is invested his money from the beginning, so he can ask full money. Full money means full earnings for the period. But in case of in case of the investor who is invested in the middle of the year, he put his money only in the middle of the year, so he cannot expect full profit for the year. You understood logically what I am saying? So for that reason only we have to do some weight. We have to do some weight adjustment. Weight adjustment is nothing but adjusting the time according to the holding period. So if you go through here, the number of equity shares issued in computing EPS is the weighted average number of equity shares outstanding during the period. Then you can ask me one question, sir, there is no new issue during the year, there is no buyback during the year, then whether we should calculate weighted average number of equity shares? Not required. If there is any additional issue during the year, or if there is any buyback during the year, then we have to give some adjustment. That is weighted average number of equity shares. If there is no new issue during the year, no buyback during the year, then not required to do these adjustments. Logically, why we are adjusting? One fellow is invested from the beginning of the year, so he is eligible for full profit. But one fellow is invested in the middle of the year only. So logically he is not eligible for full profit. Whatever the period he invested, for that only he is eligible. So accordingly we have to do some adjustment in the numerator. That is, numerator is weighted average number of equity shares. Okay. So what adjustment we have to do it? How to do it? The weight is based on holding period of shares. Of course, if the one shareholder is holding for 12 months means, then no problem. No problem means he is eligible for his shares will be treated as only one. One fellow is, for example, another fellow is invested one share after 6 months. Okay, then his shares will be treated 0.5 only, because half of the year only is invested. Then he will not be counted. His share will not be counted as one. Only 0.5 will be counted. How we have to do it, sir? There is a working method we will work out. So weight becomes necessary. The weight becomes necessary to adjust the effect of fresh issue of shares, buyback of shares, etc. during the period. So that's why the weight plays actually. The weight comes when there is a new issue of shares or buyback of shares during the period. Okay. The weight became necessary to adjust the effect of fresh issue of shares, buyback of shares, etc. during the period. So where is the problem? The problem is available at our material itself. So we'll move on to material. Look at this problem. So illustration 26, weighted average number of equity shares has been illustrated as follows. What is the problem? Accounting year Opening balance of shares, they have 1100 shares actually. And what happens, as on 1/4/2016 they have opening balance of 1800, and the next step is 39/2016, that is after 6 months they issued new shares. Issued for cash how much? 600 shares they issued new shares. Okay, then what happens? 29 to 2017, 29 to 2017 what happens? They bought back the 300 shares. 29 to 2017 what happens? They bought back the 300 shares. This is the question. Okay. April, May, June, July, August, September. So on 29/2/2017, the buyback is 300 shares actually. On closing balance 31st March 2017, their closing balance come to the last column 2100. Okay, so now the question is, they have a closing balance of 2100. What is their opening balance? 1800. What is their closing balance? 2100. Both are not same, because there is an issue during the year and there is a buyback during the year. So we have to give some adjustment for the timing effect. We have to give some adjustment. Okay, so why we are giving this adjustment? Because the person who is holding the shares from the beginning, 2800, and he is eligible for full earnings. Whereas the person holding the new shares, the person holding the shares on 39/2016, he is not eligible for full earnings, because he is invested his money only from 600 on 39/2016. And also the buyback is happened when actually on 29/2/2017. So out of the two solutions, I will be choosing the second one, B. I will work out the problem by method B actually. What is the opening balance? Opening balance is 1800 shares, correct? Holding period is 1/4. From the beginning of the financial year itself, this shares is held by the shareholders. Okay, and what happens? New issue of how many shares actually? New issue of 600 shares. So date is 30/9/2016. That is around 6 months. After 6 months it has been issued. First 6 months is over already. And the buyback means what? Company is buying back the share from the shareholder, correct? How many shares? 300 shares. What is the date actually? What is the date of buyback? 29/02/17. So what is the meaning? Buyback 300 shares, 29/02/2017. That means the 300 shareholder is a shareholder for 11 months in this company actually, correct or not? On 29/02/2017 only these shares are bought back by the company. That means for the first 11 months they are the shareholders of the company, but for the final 1 month they have not become the shareholders, because their shares are purchased on 29/02/2017. Financial year is 2016 to April 2016 to March 2017, correct? So for the first 11 months period they are the shareholder of this company only, but on February end only their shares are bought back. Okay, meaning for first 11 months their money is invested in company only. Okay, so with this understanding we have to work out the problem. So first what I am doing, two method is there. I am choosing the second method. As per your intro material, I am choosing the second method. 1800 into, assuming 12/12. Okay, the shares are kept as 12/12 plus 600 shares. 600 shares is issued in between the middle of the year, meaning the shares are kept in the company. Shareholder invested the money only for 6 months. Out of 12 months shareholders invested money only for 6 months. So 6/12. plus, sorry, not plus, minus. Why minus? I am choosing the second method, and buyback, because of buyback it is minus. That means shares are bought back. Shares is reduced from the company share capital. So minus. How many shares bought back? 300 shares. When it is bought back? February only it is bought back. That means this 300 shares, shareholder money is not there in the company for only 1 month. 1 bar 12. 1 bar 12. Okay. Do you understand what I am saying? In first case, 1800 into 12 bar 12. The shareholders money is kept fully throughout the year, that is the assumption. Second case, 600 shareholders invested only in the middle of the year, so 6 bar 12 minus 300 into 1 bar 12. Why minus? Because it is deletion, buyback. Why it is minus? It is because it is deletion, buyback. Shares are bought back again. So I am deleting. For what I have to delete? For only 1 month I have to delete, because out of 12 months only 1 month the shareholder is not there in the company. Balance 7 months this shareholders money is in this company only. So with this logic, what is the answer you are getting? Instead material answer for B, it is wrong actually. So 1800 plus 300 minus 25 equal to 2075. Okay, just correct the material answer. This is the correct thing. They did wrongly here actually, but the answer is this one only. Okay, I hope you understood. So we'll move to the next topic. So this is why we are doing. This is called weighted average number of equity shares. This is called weighted average number of equity shares. Okay. Next topic is concept of equivalent units. Partly paid share, different nominal values, etc. So what is this concept of equivalent units? So equivalent units is nothing but in a company, the company may issue share capital in a different variant actually. Different variant means, for example, different variant, and one more example is even company may not collect the full money from the shareholder. Company may not collect the full money from the shareholder, meaning company is issuing face value of rupees 10 rupees, but they called up only 5 rupees. Balance 5 rupees they did not called up. You got it on what I am saying? So in such case, what we have to do? We have to arrive the equivalent unit. Again we have to apply the weight actually. Again we need to apply the weight concept. What is this weight concept? For example, in one company there is two types of shareholder. Okay. One is fully paid shareholders and another one is partly paid shareholders. One is fully paid shareholders, another one is partly paid shareholders. Okay. Totally that company is having 2 lakh shares actually. Assuming that company is having 2 lakh shares. Out of 2 lakh shares, 1 lakh shareholders fully paid the amount. Out of 2 lakh shares, 1 lakh shareholder fully paid the amount. Balance 1 lakh shareholder paid only half of the amount. For example, face value is 10 rupees. First 1 lakh shareholders fully paid the 10 rupees. Balance 1 lakh shareholders paid only 5 rupees. In this case, what is my weighted average number of shares? What is my concept of, what is my equivalent unit? You got it or not? Because one fellow is paid fully, another fellow is paid only partly. So accordingly we have to share the revenue. Accordingly we have to share the earnings. Earning per share should be shared accordingly. Logically, if one fellow is paid full money, then he is eligible for full earnings. Another fellow only paid the part of the money, then he is not eligible for full earnings. We have to do some adjustment. Again we have to do some weight adjustment. Here also we have to do weighted average. That is why it is called as concept of equivalent unit. Instead of weighted average, it is mentioned as equivalent units. Okay. So just go through the theory. while computing weighted average of equity shares, the partly paid shares are treated proportionately of an equity shares to the extent they are eligible to receive dividend compared with the fully paid shares. Logically, if fully paid means they are eligible for full earnings, partly paid means they are eligible for part earnings, whatever they invested money, for that only they are eligible. That is the logic actually they are applying here. That's why they have said here, while computing weighted average of equity shares, the partly paid shares are treated proportionately of an equity shares to the extent they are eligible to receive dividend compared with fully paid shares. Okay, say for example fully paid shareholders are receiving 10 rupees earnings, means partly paid up share eligible for only 5 rupees because they paid only half of the amount. This we have to arrive by formula. So similarly, for shares having different nominal value but comparable dividend rates, the concept of partly paid shares will be applied here too. There is another scenario in company itself. What they will do, different type of shares they will issue to the shareholder. For example, they will issue they will issue the face value worth of 10 rupees per share. The same company they will issue another type of shares. Okay, that face value is only 5 rupees. You got it or not? Instead of partly paid, here it face value itself different actually. They can issue different type of face value of shares actually. Face value of shares they can issue. So in such a case also, similar to partly paid, whatever you do, the same thing you have to apply here. Okay. So here the example. We'll move to the example. So look at this example actually. Look at this example. This is related to partly paid shares, equivalent units. Okay. So number of shares issued, opening balance. On opening balance, how much? 1800 shares. Nominal value of shares is how much? 10 rupees. Amount paid how much? 10 rupees. So there are shareholders in opening balance 1800 shares, and their face value is 10 rupees, and the paid up capital is also 10 rupees. Okay. And what happened on 1st February 2020? What happened on 1st February 2020? Issue of shares how much? 600 shares. Nominal value of shares how much? 10 rupees. Amount paid how much? 5 rupees. So here on 1st February only they issued 600 shares. Face value is 10 rupees, but amount paid only 5 rupees. So it is partly paid. Correct? So we have to work out this problem. I think here the answer is available. Computation of weighted average be as follows. What is the thing they did? In first case, you take the first 1800 shares. They are the shareholder from the beginning of the year. So 1800 into 12 bar 12. Why 12 bar 12? Because their money is invested throughout the year. Okay. So in another case, what happens? Next case, only on 1st February 2020 the amount is invested in the company. Only on 1st February 2020 the amount is invested in the company. How many shares is invested? 600 shares. How many shares is issued? 600 shares. Correct? So 1st February 2020 means how many months they invested in this period? Out of 12 months, how many months they invested? April to March, 12 months. Out of that, February 2020, March 2020, 2 months only they invested the money. You got it on what I'm saying? They invested only 2 months. So 600 into 2 bar 12, 600 into 2 bar 12 into 5 bar 10. 600 into 5 bar 10 into 2 bar 12, or 600 into 2 bar 12 into 5 bar 10. Why 5 bar 10 actually? Why 5 bar 10? Because the nominal value of share is 10 rupees, but they paid only 5 rupees. Because the nominal value is 10 rupees, but they paid only 5 rupees. That is the 5 bar 10. That is one effect. Another effect is 2 bar 12. Why? Because they invested on only February. February means 2 months only they invested in the company. So they are eligible for 2 months earnings. That is why 2 bar 12. Okay. 600 into 5 bar 10 into 2 bar 12, that one answer, plus 1800 into 12 bar 12. That is one answer, equal to 1850 shares. Okay. We'll go to the next topic. So the next topic is bonus issue. Next topic is bonus issue. What is bonus issue? General meaning of bonus issue. Issue of shares is different types of issue of shares, correct? One is public IPO, initial public offer, and another one is FPO, follow-on public offer. You have rights issue. You have bonus issue also. So what is this bonus issue? Bonus issue is nothing but I am issuing shares to my existing shareholder at free of cost. I am not charging anything. I am not going to charge any amount to the existing shareholder. It is free of cost I am issuing. How I am issuing from free of cost? Because I have an accumulated profit in my company. I have already existing profits in my company. That profit I am going to transfer to share capital. Okay. From profits, accumulated profits, so it is transferred to share capital. From the accumulated profit, I am issuing existing shareholder shares at free of cost. You got it or not? This is bonus issue. Okay. So whether money is coming inside to the company or not, no money is coming inside to the company. Only we are issuing shares at free of cost. Why we are issuing free of cost? Because we have a lot of profits. Maybe we have a lot of profits, accumulated profits in a company. So out of that accumulated profit, we are issuing shares. So what is the effect in earning per share? Whether we have to give some weighted average, whether we have to give some any other things, sir, whether we have to do some adjustment or not, sir, not required. Okay. So the point is, if it is a bonus issue, then we need not to give any weight effect for the denominator. We will not to give any weight effect for the denominator. Okay. So bonus shares are issued from the accumulated profits to existing shareholder at free of cost. Bonus shares are issued from the accumulated profits to the existing shareholder free of cost. Then no weightage should be assigned. No weightage should be assigned for timing issue due to free of cost. If I am getting bonus share means I am not putting any effect. I am not, because it is issued from the cost profits, accumulated profits, and I am not going to spend, as a shareholder I did not spend any money on this. So there is no weight. Whether if I issue bonus share in the middle of the year or end of the year or beginning of the year, no matters. That will not matter. That will not affect my denominator, because it is issued from the accumulated profit. Past profit it is issued. So, and also it is issued in free of cost. So weightage issue will not be there. We need not to assign any weightage. Since bonus issue does not involve any further consideration, such issue will be treated as if it occurred prior to the beginning period, the earliest reporting period. So whenever the bonus shares is issued, it is issued assuming it is issued from the earliest reported period. What is this earliest reported period? Normally, whenever you are presenting the financial statement, you will not present for the present year only. Normally, if you go through the in practice, if you go through the financial statement of the any companies, they will present for the present year as well as previous year, current year as well as previous year. Both year they will present. You got what I am saying? They will not present only for 1 year. They will present for 2 years. So in that case, what will happen? If the bonus shares is issued means, this bonus shares effect will be given to present year as well as previous year. We will work out the problem, we will understand. We will work out the problem, we will understand. What is the next one? Yeah, that's what they are trying to say. If the previous year EPS were not adjusted, comparison with the current year figures will not be meaningful. Hence previous year EPS represented after the effect for bonus issue. Okay, that we will work out, we will understand how we have to do that, we will understand. So we will work out a problem, we will work out a problem from the material, we will work out the problem from the material. So look at the problem, illustration 27. Illustration 27. What is the problem? Net profit for the 2014-15 is 18 lakh. Net profit for the year 2015-16 is 60 lakhs. Number of equity shares as on 31/12/2015 20 lakhs. Okay. Bonus issued on 1/1/2016 is 2 equity shares for each equity shares outstanding at 31/12/2016. Okay, compute the EPS for 2015-16 and adjusted EPS for 2014-15. So this is the question. We will work out the answer. So there is totally 2 years. One is 2014-15, another one is 2015-16. 2014-15 is previous year, 2015-16 is current year, present year or current year. Okay, so 2015-16, what happens? 2015-16 EPS we have to calculate first. So as per the question, 2015-16 profit is 60 lakh. Basic earnings, we have to assume this is basic earnings. Okay, and how many shares they have actually? How many shares they have? Existing shares, how many shares they have? 20 lakh shares they have, correct? What is the bonus ratio? What is the bonus ratio? 2:1, 2:1. If you have one share, they will issue 2 shares. They will give 2 shares at free of cost. If you have one share, they will give 2 shares. So 20 lakhs into 2 will get 40 lakhs. So 20 lakh plus 40 lakhs equal to how much? 60 lakh shares you will get. Forget about timing and all. Forget about timing. Why we have to forget about timing? Because this is bonus. Shareholder is receiving the shares but he is not paying anything. Shareholder is receiving shares at free of cost. So no need to apply weight actually. No need to apply weight because shareholder is receiving the shares at free of cost. So in this case 60 lakh shares is the number of shares, correct? So what will be the EPS for the current year? What will be the EPS for the current year? 60 lakhs rupees basic earning, 60 lakhs divided by 60 lakhs equity shares equal to how much? Rupees 1. Rupees 1. Okay. So this is one thing, and they are asking adjusted EPS. Adjusted EPS actually. Actual EPS, first you should know what is actual EPS. Then we will go to the adjusted EPS. Actual EPS for 2014-15 is what? Actual EPS for previous year. I am talking about previous year, not present year. Present year is over. Forget about present year. Previous year I am just working out. What is the net profit? 18 lakh. Correct? What is the net profit actually? 18 lakh rupees divided by, before bonus what is their EPS? Sorry, before bonus what is their shares? 20 lakh shares, correct? because existing share is how much? Existing shares is how much? 20 lakh only. Bonus is issued only on 15/16. Normally we will write this one only, correct? Normally this is the answer. Actual EPS is 18 lakh divided by 20 lakh equal to 0.9 per share. This is the answer. Normally we will write. But in case of bonus issue, as per AS20, because of the bonus issue, normally bonus issue is issued from the accumulated profits of the from the past profits, accumulated profits from the past actually, meaning whatever the profits available in past, from that only it is issued. So we have to give this effect for previous years also. That is why they are asking us to present the adjusted EPS. What is adjusted EPS? Adjusted EPS. What is this adjusted EPS? Adjusted EPS is nothing but giving effect to the bonus amount. So what is my profit? 18 lakh is my profit, divided by 20 lakh shares is my existing shares, plus bonus shares 40 lakhs, equal to 60 lakhs will come. So 18 lakh divided by 60 lakh equal to how much? 0.3 per share. Okay, that is what they are asking actually. Sir, why we are doing this like this, sir? Means bonus is issued from the accumulated profit. Accumulated profit means it is accumulated from the present year, it is accumulated from the past years also. So we have to give effect for the past years also. Okay, that is why they are saying, assuming it has been issued from the earliest period. If you go through this third bullet point, it says, since bonus issue does not involve any further consideration, such an issue will be treated as if it had occurred prior to the beginning of the year, the earliest reporting period. Normally earliest reporting period is previous year, because 2 years financial only we will present. So that is why we are giving effect for the previous years also. Okay, so bonus issue is over. We'll go to the next topic. So the next topic is rights issue. What is rights issue? As I said, issue of shares having many types, like IPO, FPO, bonus issue, and another thing is rights issue. What is this rights issue? It is an issue to the whom actually? The rights issue means who is having that right actually. It is an issue to the existing shareholder. Existing shareholder is having right to purchase the shares. That is rights issue. Okay, offering shares to the existing shareholder. Normally, if I offer anything to existing shareholder, I will give some discount. Why? Because they invested already money in company. Because of their investment only, we are running the company. So we have to offer some discount in the price actually. We have to offer some discounted price to the existing shareholder. Then only they will be attracted to purchase the shares. Okay, rights issue is offer to an existing shareholder with some discounted price. Maybe, for example, market price of the share is 100 rupees. Company will offer at 90 rupees. That is a discount of 10 rupees. Why? Because they are our existing shareholder. We have to offer existing customer. Like existing customer, we used to offer discount. Like that, we have to offer some discount to the existing shareholders. Okay. So, what is mentioned here? Shares offered to existing shareholder at or below fair value in the market. Shares offered to existing shareholder at or below fair value in the market. Okay. What is the next thing? If it is offered below fair price, the issue is treated as though there were two separate issues, one being bonus issue and another being issue at full price. What is the meaning? If it is an offered below fair price, the issue is stated as though there were two separate issue, one being bonus issue and other being at full price. What is the meaning? So as I said, no. Actually, the price is 100 rupees. Price is 100 rupees. Market price is 100 rupees. But I am offering at 90 rupees to my existing shareholder. What is the discount here? 10 rupees. That discount is a bonus element. That discount is a bonus element. Why that discount? Why that bonus? Because they are our existing shareholder. Because of them only we generated more profits. We have an accumulated profits in our company already. We have an accumulated profits in our company. That is why I am offering at some discount. I am giving some bonus to my existing shareholder. You got it or not? So what we have to do with this bonus? We have to give some bonus. We have to give some effect for this bonus. Actually, we have to give some effect for this bonus in the workings. We will understand that. Before that, you should know what is rights issue. What is the meaning of rights issue? Rights issue is an offer to the existing shareholder at some discounted price below the fair price. That is what they said here. If it is offered below fair price, means fair price may be 100, but I am offering at 90 rupees. Why? Because they are our existing shareholder. So if you offer 90 rupees, then what is the meaning of the 10 rupees? That is like bonus share. That is like bonus issued to my existing shareholder. Okay, we have to give some effect for this bonus. Okay, so what is the next point? The next point is the cum right price is the actual market price of existing shares on the last day when the purchase of shares includes the right to subscribe for the new issue. So technical thing they are saying. So before whenever the rights issue is made, okay, whenever the rights issue is made, on the date of the rights issue made, what is the market price? On the date of the rights issue, what is the market price? Maybe 100 rupees. On the date of the right issue, what is the market price? Maybe 100 rupees. Then what is the market price after the right issue? Then what is the market price after the right issue? That also we have to check. Because before right issue, my market price is 100. I am offering at 90 rupees. I am offering at 90 rupees. Because of that, there will be some reduction in the market price. Because of that, there will be some reduction in the market price because of this bonus element. So the cum right price is normally a market price before the rights issue, whatever available in the market price, that is cum right price. Okay, then come to the next continuation. The X right price. X right price is the theoretical price at which shares to be priced immediately after the right issue. What is the meaning of this one? Before rights issue, for example, before rights issue, this company is having 1 lakh shares. Before rights issue, this company is having 1 lakh shares. Okay, and the market price is 100 rupees. Market price is 100 rupees. Then what is the total value? What is the total value? What is the total value? Better I will work out a small problem. You will understand. So cum right. So before rights, market price is 100. Before rights issue, okay. Before rights issue, market price is 100. For example, this company is having 10,000 shares and they are issuing at 1:1. 1:1. If you have 1 share, company will give 1 share at rupees 90 per share. At rupees 90 per share they will give. Okay. So Company is having 10,000 shares. Company is having 10,000 shares. 1:1 is the ratio. That means 10,000 plus 10,000 equal to 20,000. Correct? So what we have to do? What is my market price before rights issue? 100 rupees. What is the offering price for rights issue? What is the offering price for rights issue? 90 rupees. Correct? So then what is my X right price? What is my X right price? It's nothing but 10,000 share initially I am having. 10,000 share initially I am having. What is the market price? 100 rupees. And I am going to purchase rights issue. Full purchase made. Assume full rights issue is accepted. So 10,000 into 90 is the purchase price. So divided by existing shares how much? 10,000 shares plus right shares how much? 10,000 equal to how much? 10,000 into 100. 10,000 into 100. 10 lakh rupees. Correct? 10 lakh plus 9 lakh is 19 lakh. 10 lakh plus 9 lakh equal to 19 lakh divided by 10,000 share plus 10,000 share, 20,000 shares. 10,000 shares. Then what will happen? So what is the next thing? Equal to rupees 95 per share. This is my X right price. This is my X right price. So before right issue, my share price is 100. Fair value is 100. I made a right issue of 90 per share. I offered at 90 per share. Because of this thing, what happened? After right issue, my share price become 95. My share price become 95 per share. Okay, how? Because 10,000 into 100 is my existing shares. Right issue is 10,000 into 90 divided by 10,000 plus 10,000 will give you 95 per share. Okay, this is what they are trying to say there. How to calculate? Formula for this one. The ratio between cum right price and X right price is used to identify the bonus component of the rights issue as follows. Bonus factor equal to fair value prior to rights divided by theoretical X right fair value. Bonus factor equal to fair value prior to rights divided by theoretical X right fair value. In our problem, what is the fair value then? In our problem, what is the bonus element? What is the bonus element in our problem? So what is the bonus element? Bonus factor. Bonus factor means discount. How much discount is given in this rights issue? So before rights issue, market price 100. After rights issue, my fair price becomes, before rights issue my fair value is 100. After right issue my value becomes 95. So 100 divided by 95. 100 divided by 95, how much? 100 divided by 95, how much? 1.05. This is the bonus factor. This is the bonus factor. This 0.05 is my bonus factor. 0.05, because of this 0.05 bonus factor only my share price becomes reduced. Because of this 0.05 only my share price becomes reduced. Why? Because it was there 100 rupees, you offered 90 rupees, no? Because of that my overall share price got reduced. Okay, why we are calculating this? Why we are calculating this bonus factor? We have to do some adjustment while arriving the total number of shares. We have to do some adjustment while arriving the EPS. Actually, in case of rights issue we have to do some adjustment with this bonus factor. Now you can ask me a question. Actually, now you can ask me a question: if the fair value and the rights issue price both are same, whether there will be bonus factor or not? If the fair price is 100, equal to 100 rupees, rights issue price is also 100, rights issue price is also 100, fair value is also 100. Whether is there any bonus effect, sir? No bonus effect, because you are not offered any discount. Market price is also 100 and you are also offering at 100 rupees, so there will not be any bonus effect, discount effect. Okay, in such a case this bonus factor we need to identify. Only if there is a discount in the offer price, then we have to identify this bonus factor. Why we are identifying this bonus factor, sir? Because this will be helpful for the arriving the solution. There will be a problem on this, for that only we have to understand this actually. Okay, so what is the next step? So the next point is, that's whatever we calculated now. Theoretical X right fair value equal to, this is formula just now I applied, total fair value of existing shares. Total fair value of existing shares, what we did actually, 10,000 into 100. Just now we did, no, 10,000 into 100 is total fair value of existing share plus proceeds from rights issue. What is the proceeds from right issue? We just know worked out. 10,000 into 90. 10,000 into 90 is proceeds from rights issue. Okay, so 10,000 into 100 plus 10,000 into 90 divided by 10,000. Total number of existing shares how much? 10,000 plus number of rights issue shares how much? 10,000. 10,000 plus 10,000. So numerator is 10,000 into 100 plus 10,000 into 90 divided by 10,000 plus 10,000 equal to theoretical X right fair value, that is R95. Okay, what is the next point? Since bonus element does not involve any further consideration, such portion will be treated if it had occurred prior to the beginning of the year, the earliest reported period. Similar to bonus shares, what we did, the same thing we have to do it for rights issue also, but only for the bonus element, not for total shares. Because right share we are not offering at free of cost. You understood or not? Right share we are not offering at free of cost. We are collecting money from the shareholder, but the point is we are giving some discount. That discount is bonus. For that bonus only we have to give this effect for the previous years also. That also we will work out. The same thing, if the previous year EPS were not adjusted, comparison with current year figures will not be meaningful. Hence previous year EPS represented the effect for bonus element. Previous year EPS should be adjusted accordingly. Okay, because that rights issue is issued at discount, that is bonus. That bonus is from accumulated profit. From the past accumulated profit only I am giving this discount to my existing shareholder by way of rights issue. Okay, refer illustration, material illustration. We will work out the problem from the material. So the problem is So just go through this illustration 28. This is related to right share. Okay, this is related to right share problem. uh, there is small error in the question actually. This year you can treat it as accounting year, not financial year. That is calendar year, you treat it as a calendar year. Okay, net profit for 2014-15 is given. Assume this is 2014. Assume this is 2015. Instead of 14 you can assume this is 2015. Like that, net profit for 2015-16 you can assume that is 2016. Okay, assume that as an calendar year. That year is for first one is for 2015, second one is for 2016. That assumption you please take it. There is an error in the question. Okay, so net profit for first year is 2015, second year is net profit for second year is 2016. This assumption you keep it in your mind. Forget about the year given in the material. Just you assume like that. Net profit for 2015 is 11 lakh, net profit for 2016 is 15 lakh. Okay, so then what is the next thing? Number of shares outstanding prior to rights issue 5 lakh shares. Existing shares, that is called existing shares, is how much? 5 lakh shares they have actually. Then rights issue, what is the rights issue percentage? 1 share for 5 outstanding. 1 share for 1:5. If you have 1 share they will give 5 sorry, if you have 5 shares they will give 1 share. Okay, 1:5. If you have 5 share they will give 1 share. That is 1 lakh. They also arrived the answer. So 5 lakh divided by 5 lakh divided by 5 will give you 1 lakh. 5 lakh divided by 5 will give you 1 lakh. Okay, what is the right price? Right price is how much? That is rights issue price is 15. Then what is the next thing? Last date of rights option. Last date of rights option. What is this last date of right option? Why they are giving this one actually? So the point is, whenever the company is offering rights issue to the existing shareholder, they will come with some last date. They will come with some exchange date or last date. Within that date, everyone, that existing shareholders should give their consent. Whether they are interested in purchase or not, they will give their consent to the company. Okay, offered by the company, and it should be accepted before some date. That is called last date. Why they are giving this date actually? From this date only we have to work out actually. Relevant things we have to work out from this date. Exchange date. This is called exchange date. Okay, last date of right option is exchange date. That is 1st March 2016. Before 1st March 2016 they need to accept whether they are interested in purchasing or not. Extra shares, rights issue, that existing shareholder is interested in purchasing or not, they need to inform to the company. What is the next one? Fair value prior to the right option on 1st March 2016 is 21 per equity shares. Existing right price means existing market price before rights issue, it is 21 per share. Existing market price before rights issue is 21 per share, and right issue price is 15 rupees. We need to calculate what actually? We need to calculate computation of EPS. We need to calculate EPS. Okay, so this is the question. We will work out the answer. So rights issue, one is to 5. Existing shares, 5 lakh. Right shares, 5 lakh divided by 5 will give you 1 lakh. Okay, so this is right shares, and also fair price, come right, that is come right is 21, correct? Come right is 21 rupees. We need to identify, what? X right price, that is theoretical X right price. Okay, that is 15 rupees. Theoretical X right price is 15 rupees. Okay, sorry, not 15 rupees. We have to identify this one. Issue price is 15 rupees. What is issue price? ₹15. Okay, we have to identify theoretical X right price. What is the formula for theoretical X right price? Theoretical, just I am writing an abbreviation. Theoretical X right price equal to fair value of existing shares plus proceeds from right issue. Fair value of existing share plus proceeds from right issue divided by existing shares plus right shares. Okay, fair value of existing shares, how to identify? So how many shares you have? Existing shares 5 lakh into what is my existing fair price? Existing market price is how much? 21 plus proceeds. How many right shares I am issuing? 1 lakh shares I am issuing. At what price I am issuing? 15 rupees. Correct? Divided by existing shares 5 lakh shares plus right shares 1 lakh will give you how much? Will give you 1 crore 5 lakh 1 crore 5 lakh, okay, plus 15 lakh, correct, divided by 6 lakh, equal to how much? Equal to rupees 20. Okay, 20 rupees is my theoretical X right price. Why I am calculating theoretical X right price? Because I need to identify the bonus element. Bonus element, why I am identifying? Because I have to adjust my weighted average number of shares for the bonus element. Why I am adjusting? Because bonus is issued at free of cost. There is a discount portion in the issue. So I have to identify that discount portion and I have to give effect in my number of shares. So before, what is the formula for bonus element? come right price, that is before rights issue, divided by theoretical ex right price. Something is happened. Okay, what happened? Please ignore this symbol. I don't know how to eliminate this one. Okay. So theoretical X right price. So the thing is come right price divided by theoretical X right price. What is the come right price? 21 divided by theoretical X right price 20 equal to, what is the bonus factor? What is the bonus factor? 1.05. That 0.05 is the bonus factor. Okay. Why we are calculating this bonus factor, sir? Because that is free of cost, discounted price. Then why we are calculating? Because we need to give some adjustment in the weighted average number of shares. How to give? That we will work out now. So the bonus factor is 1.05. Then EPS for the current year. First we will identify EPS for the current year, and also we will do for the previous year also. Okay. EPS for the year 2016, 2015. Okay. So what is my basic earnings? Basic earnings given in the question. Basic earnings given in the question. Basic earnings is 15 lakh divided by when the issue is exercised, when the last date of issue, assuming this is accounting, assuming this is calendar year. Okay, assume this is calendar year. What is the last date? What is the last date of last date? Last date is 1st March 2016. Assuming this is calendar year 1st Jan to, okay, 31st December. Okay. So 15 lakh is my total earnings for the year 2016. For the year 2016, my 15 lakhs, and the existing shares how much? 5 lakh. Existing shares 5 lakhs. And what is the bonus factor? What is the bonus factor? What is the bonus factor? 1.05, right? On the existing shares, this bonus element should be multiplied. On this existing shares, this bonus element should be multiplied into, when the, what is the last date for exercising the rights issue? 1st March 2016. How many month? Totally 12 month. Totally 12 months, right? Out of 12 month, 1st March 2016 is the last date, means January not excised, January not excised, February not excised, 2 months not excised, correct? On March only it is excised. First 2 months rights issue is not excised. For this first 2 months only, for this bonus effect should be given. Okay, for the existing shares into 2 bar 12 into 2 bar 12 plus after 2 months, January is over, February is over, then on March onwards how many shares I am having? March onwards how many shares I am having? 5 lakh is existing shares plus rights issue 1 lakh. 5 lakh plus 1 lakh, 6 lakh shares I am having from March onwards. So 6 lakh shares, 6 lakh shares into 6 lakh shares into how many months there I am holding in this 2016? From March only I am purchasing these shares, correct? So in this year I am having 10 months. Out of 12 months I am invested my money for 10 months. So 6 lakh into 10 bar 12. 6 lakh into 10 bar 12. So what should be the answer? 15 lakh divided by so and so thing. Finally you will get 2.25 or 2.55. So the answer is not correct at the material. Okay, correct answer is 15 lakh 15 lakh divided by 15 lakh divided by 87,500 shares plus 5 lakh shares. Okay, plus 5 lakh shares will give you 2.55 per share. That is the correct answer. 2.55 per share. Okay, so this is the EPS for 2016. Okay, then we need to work out for 2015 also. 2015 existing EPS, adjusted EPS, both. 2015, first we will calculate the existing EPS, that is without bonus. You may ask, sir, we need to do anything for rights issue portion? We need to give any effect for previous year for the rights issue portion or not? We need not to give any effect for rights issue portion. Only we need to give effect for bonus portion. Okay, what is the previous year profit? What is the previous year profit? 11 lakh. 11 lakh is the previous year profit divided by how many shares? Existing shares 5 lakh equal to rupees 2.2. Okay, then adjusted, this is what very important, adjusted EPS. Why we are adjusting? Because there is a bonus element in the present year. That bonus element adjustment should be given effect and represented with the previous year EPS also. Previous year EPS earnings 11 lakh divided by 5 lakh is my existing shares into 1.05 into 1.05. You can ask me whether we should put 2 bar tolls or not. You should not put 2 bar toll and all. Okay, because that is for the present year. Present year the rights issue is issued on March 1. So for that first 2 months only we have considered the bonus effect. But for the previous year, full year you have to take it. Okay, because from the previous year profit only we have given the bonus issue. From the previous year profit only we have given the bonus issue. Previous year profit, previous year profits, accumulated profit only we are giving this bonus element. Okay, so 11 lakh divided by 5 lakh into so and so thing will give you 2.1. Okay, so this is the answer. One answer is 2.2, that is existing EPS for the previous year. Adjusted EPS for the previous year is 2.1, and one more thing 2.55, that is main thing. That is for the EPS for the current year. That is for the EPS for the current year. Okay, we'll move to the next problem. Oh, what is the next thing? Diluted earnings. What is this diluted earnings? So till now we discussed about basic earnings. Basic earnings is nothing but to arriving the earning per share. If you go through the schedule 3, in the format actually, under the P&L statement, that income statement, you have all the items, income, expenses, net profit, extraordinary item, then taxation, then appropriation. Finally, you will have basic EPS as well as diluted EPS. You have basic EPS as well as diluted EPS. What is this diluted EPS or diluted earnings? What is the meaning of this diluted EPS? Okay, before that we have to understand little theory. What is this given here? Profit belongs to equity shareholder under basic EPS is required to be adjusted further. This adjustment may include dividend on potential equity shares and interest on potential equity shares. So what they are trying to say is, basic EPS, you know, that is basic earnings divided by weighted average number of equity shares. WANES. WANES is weighted average number of equity shares. So what is this diluted earnings then? Diluted earnings is nothing but there are some securities, there are some instruments, financial instruments that will be convertible into shares in future. That may be convertible into shares in futures. For example, convertible debentures. Convertible debentures. What is the meaning of convertible debentures? We issue debentures presently, but that will be convertible. That may be convertible into shares in futures. That may be convertible into share in future. Correct? That is convertible debenture. Debenture is converted into shares. So that is called potential equity shares. Potential equity shares means that a particular financial instrument which may give some grip, or what you can say, the potential equity shares is whether we will go to the theory. So what is given here? Potential equity share is a financial instrument that entitles its holder to equity shareholders. Equity shares. Okay. A financial instrument that entitles its holder to equity shares. What is the meaning? I'm having debentures, sir. I'm having a convertible debentures. It is a financial instrument, and also it is convertible into shares, and also it is convertible into shares. Then that is potential equity shares. Then that is potential equity shares. If anything is convertible into equity shares in future or in near future, then that is potential equity shares. Okay. So why this we are discussing? What is the reason why we are discussing? So the objective of discussing this one is, you have an existing EPS, you are getting existing EPS of 10 rupees, for example, earning per share 10 rupees you are getting. Okay. Somebody will ask this question: if your potential equity shares is converted into equity shares, if your potential equity shares are converted into equity shares for some reasons, in future they are converting the debentures into equity shares, then what will be the EPS you will get in such scenario? Then what will be the EPS you will get in such scenario? You got it on what I'm saying? Presently I'm getting good EPS. Okay, I'm happy. 10 rupees I'm getting. Okay, I'm a shareholder, existing shareholder. I'm happy with the existing EPS. But if the convertible potential equity shares are converted into shares in future, then what EPS I may get? What EPS I may get? I wanted to know that, right? For that I have to understand the dilutive. Dilutive means, if I convert the potential equity shares into equity shares, because of that conversion, is there any reduction in my existing EPS? Is there any possibility of reduction in my existing EPS or not? For example, if my existing EPS is 10 rupees, I am happy with 10 rupees per share. I am able to get 10 rupees per share. If these convertible debentures is converted into equity shares, then what EPS I will get it? That is the question existing shareholder can ask, right? You got it or not? So we have to give that information also. Potential equity shares means, if these instruments are converted into equity shares, then actually what will be the EPS? Whether it is dilutive in nature or not. If it is dilutive means, whether it is reduced, whether there is a decrease in the existing EPS or not. That is called dilution. Dilution means reduction, or there is a decrease in the existing element, existing figure, there is an element reduction. Okay. So potential equity shares, a financial instrument that entity entitles its holders to equity shares. Convertible debentures, convertible preference shares, share warrants, ESOPs, contingently issuable shares, all these things are potential equity shares. Maybe convertible debentures or convertible preference shares, all these things can be converted into equity shares. Example for potential equity shares. Okay. So then what we have to do next? Why we are calculating this? We have to calculate, like we have to assume that all these convertible things are converted into equity shares. Then what is the EPS we are getting? That we have to calculate. Whether it is a dilutive in nature or not. Dilutive means whether there is any reduction from the existing EPS or not. Diluted from existing thing. Diluted from existing characteristic. Okay. There is a reduction in the existing EPS or not. That is what dilutive. Okay. So potential shares classified into dilutive shares. Conversion of these shares with dilutive potential leads to reduction in EPS from continuing ordinary operation. If I convert these shares into equity shares means, then definitely my existing EPS will be reduced. That is dilutive shares. Okay. Non-dilutive shares. Conversion of these shares with non-dilutive potential does not lead to reduction in EPS from continuing ordinary operations. If I convert if these debentures into equity shares means, then I will not my existing EPS will not be reduced. Then that is non-dilutive. We have to report only dilutive. We have to report only dilutive EPS. Okay. So how to calculate all these things? This is the formula. So earnings will be calculated as follows. Basic earnings. So basic earnings means earnings which we did for our calculating the basic EPS. Basic EPS we arrived earnings, right? That is what? Net profit available to equity shareholders. Net profit available to equity shareholder. That is your basic earnings. That is arrived after net profit after tax. Then what? And also we reduced the preference dividend. Whatever available is basic earnings. In this what we are doing actually? In this what we are doing? Plus dividend recognized on dilutive potential equity shares and tax thereon. This we are adding. Why we are adding? We will explain later. I will explain later. Plus interest recognized on dilutive potential equity shares adjusted for tax expenses. Post-tax interest plus any change in expenses or income equal to diluted earnings. So what they are trying to say? For example, convertible debentures you take. Convertible debentures you take. What will happen if I convert the debentures into shares? What will happen? If I convert the debentures into share, what will happen? If it is a debentures, what I have to pay? I have to pay interest, correct? I have to pay interest to my debenture holder. If I convert the debenture into shares, whether I should pay interest or I need not to pay interest? I need not to pay interest, right? So that is the savings for me, correct? That is why adding here interest recognized on dilutive potential equity shares adjusted for tax expenses. Means dilutive potential equity shares means it is convertible debentures only they are saying. We will work out a problem, you will understand. Okay. So better before working out the problem, we will understand this is numerator actually. Diluted earnings is numerator. We will understand the denominator also, then we will work out the problem. Adjusted WANES. Adjusted WANES means weighted average number of equity shares. WANES means weighted average number of equity shares. Adjusted means adjusted for potential equity shares. I have my existing shares. I already calculated. I know what is my EPS, correct? Basic EPS I know. On that I have to do some adjustment. How to do that? The additional equity shares which would be outstanding if all dilutive potential equity shares have been converted must be added with the existing outstanding shares considered for basic EPS calculation. With the existing outstanding shares considered for basic EPS calculation. What is the meaning actually? The additional equity shares which would be outstanding if all dilutive potential equity shares had been converted must be added with the existing outstanding shares considered for basic EPS calculation. What they are trying to say? You have existing shares and you have potential equity shares. Assume convertible debenture shares. If you convert the debentures into equity shares, you will get some equity shares. You have to add that equity shares with the existing shares. We will work out the problem. We will understand. Hence dilutive EPS equal to, this is the formula, dilutive earnings divided by adjusted WANES, that is weighted average number of equity shares. So refer additional illustration. We will work out this problem. Okay. So look at this problem. Net profit for the current year is 1 crore and number of equity shares outstanding is 50 lakhs. 12% convertible debentures of 100 each at 1 lakh debentures. What is the meaning? They have a 12% convertible debentures of 100 each. Okay. How many debentures they have? 1 lakh debentures they have. Then 1 lakh debentures into 100 equal to total value is 1 crore. Correct or not? 1 lakh debentures into 100 equal to 1 crore. Then below to that they have given each debenture is convertible into 10 equity shares. Each debenture is convertible into 10 equity shares. Then what is the next one? Tax rate is how much? 30%. Tax rate is how much? 30%. So then they are asking us to calculate basic EPS and dilutive EPS. Okay. So this is the question we have to work out. So basic EPS we need to first identify. Okay. Basic EPS equal to how much? For that, basic earnings divided by number of equity shares. Weight and all not required because no information for weightage. Only one number of equity, only single equity shares is given. Meaning there is no new issue or buyback during the year. What is the basic earnings? Net profit available to equity shareholders. Okay. This is 1 crore divided by what is number of shares? 50 lakh equal to rupees 2 per share. Okay. Then dilutive EPS. Need to calculate dilutive EPS. How to calculate that? Dilutive EPS equal to what? Dilutive earnings divided by adjusted WANES, that is weighted average number of equity shares. Forget about weight because in the question there is no weight. Okay. Adjusted number of equity shares. So diluted earnings we need to calculate. Diluted earnings we need to calculate. How to calculate diluted earnings? Basic earnings. What is the basic earnings in the question? Basic earnings in the question is how much? One crore. Correct. Then what is convertible? What is converted as equity shares? What is converted as equity shares? Debenture is converted as equity shares. Correct. As per the question. Not converted, potential equity shares. That is called potential equity shares. If it is converted into equity shares, then what is my EPS? That is what we are going to identify. Okay. Then what is my debenture? Debenture is, how many debentures I have totally? 1 lakh numbers. Correct. Into each debenture is convertible into 10 equity shares. That is the question. Correct. So into 10. Each debenture is convertible into 10 equity shares. Each debenture is convertible into 10 equity shares. Then how many equity shares I will get? 10 lakh shares. This is potential equity shares. Potential equity shares. If I convert this as into equity shares, then what is the savings for me? Interest I need not to pay to my debentures. That is the savings for me. Correct. What is my debenture value? Debenture value we saw in the question. Debenture value is 1 lakh numbers into rupees 100 per debenture equal to, what is the value? 1 crore. 1 crore is the value. Correct. Debenture value is 1 crore. Rate of interest how much? Rate of interest how much given in the question? 12% interest given in the question. Correct. Then what is 12% here? 1 crore into 12 lakh rupees is the interest. Correct. 12 lakh rupees is the interest. Correct. So now the question is whether am I saving this 12 lakh fully. Do you understand my question? If I convert into equity shares, I need not to pay interest 12 lakh rupees, correct or not? Because it is converted into equity shares. Assumption is it is going to be converted into equity shares. In such case, 12 lakh rupees is saved for me. Whether it is fully saved or whether I lost something on this. I lost something on this. What I lost? Debenture interest. Interest is debited to P&L account, or it is not debited to P&L account. Interest is debited to P&L account or not debited to P&L account. It is debited to P&L account, correct? It is an expenses. So if my expenses is increased, I will pay less tax or more tax. If my expenses is increased, I will pay less tax or more tax. I will pay less tax. If expenses is more, tax will be less, correct? Correct or not? Tax will be less because already it is adjusted as an expenses. So my profit will be less. If my expenses is more, my profit will be less. Then I will pay less tax. If my expenses is not there, then my profit will be more. Then I have to pay more tax. Correct? Simple logic. With that logic, because of this 12 lakh rupees expenses, this company is saved 30% tax on these expenses. How much? 12 into 3, 3 lakh 60. 3 lakh 60 is saved by this company. How? Because of these expenses, their profit is, they are showing less profit. So if they show less profit, they will pay less tax. If this expense is not available, then this tax saving is also not available. 3,60,000 they cannot claim. So the point is, even though interest saved is 12 lakh rupees, net saving will be after adjusting tax, because this tax expenses I am not able to claim in future. So 12 lakh minus 3,60,000 equal to how much? I think 8,40,000. 8,40,000 is my actual savings. 8,40,000 is my actual savings. So this is what I am going to add with my profits. So basic earnings equal to 1 crore, okay, plus interest savings is 8,40,000, okay, equal to, this is my diluted earnings, okay. You can ask me, you said that diluted earning means you will get less earnings compared with the existing earnings. It is not like that. We have to see the share per share whether it is reduced or not. Earnings per share only we have to compare. How to compare that? So diluted earnings divided by, what is the formula? Diluted earning per share equal to diluted earnings divided by adjusted number of equity shares, okay. In this case, diluted earnings is 1 crore 8,40,000 divided by what is my existing shares. 50 lakhs is my existing shares, plus what is the shares, what is the shares I got by converted the debentures. By converted the debentures I got 10 lakh rupees, correct? Just refer here, just how much I got it here. Just look on this, how much I got it. Just go through here. 1 lakh numbers of debenture into 10 equity shares equal to how much? 10 lakh shares. That 10 lakh only I am adding here. Okay. So 10 lakh shares equal to 1 crore 8 lakh 40,000 divided by 60 lakhs equal to how much per share? 1.81 per share. Now tell me whether this is dilutive or not. Now tell me whether this is dilutive or not. How to tell that? Basic EPS. Initially how much we calculated? Rupees 2 per share, correct? Diluted EPS equal to how much? Rupees 1.81 per share. Now tell me whether this is dilutive, reduction or not. Yes, it is a reduction, because initially my share is 2 rupees. After converting this debenture into equity share, my EPS will come to 1.81. This is called dilutive nature. This is called dilutive shares. Okay. Then what is non-dilutive? Then what is non-diluted? Assuming doing all this working and everything, after doing all these workings and everything, you are getting rupees 2.5. You are getting rupees 2.5 share, 2.5 per share. Then this is called non-dilutive. Okay, non-dilutive need not to be reported. Only diluted shares will be reported. Okay, so this is called diluted EPS. We will work out one more small problem. So this is the question actually. ABC Limited had reported a net profit of rupees 60 lakh for the year ended 31st March 2014, on which date the company is having 20 lakh equity shares of rupees 10 each outstanding. The average fair value of one equity shares during the year 2013 was 13-14 was rupees 25. Okay. Details of exercisable option are given below. Weighted average number of shares under stock option scheme for the 2013-14 is equal to 4 lakh. Okay. Exercise price of share is 20. Calculate basic EPS and diluted EPS. So what they are trying to say, there is a company called ABC Limited. Okay. Their profit is 60 lakh and their existing shares is 20 lakh. And what happens, they are offering shares to their employees. They are offering shares to the employees at some discounted price. They are offering shares to the employees to the discounted price. Actually market price is 25 rupees. They are offering at 20 rupees. How many shares they are offering? They are offering 4 lakh shares. Okay. And what is the date of exercise price? When is the last date of exercise is 31st March 2014. Okay. So now we have to identify what is the bonus element. Now we have to identify the bonus element. Exercise date is the last date of the year. Exercise date is the last date of that particular year. That is March 2014. We have to work out this problem. So first we have to calculate basic EPS. Basic EPS is how much? What is their profit? What is their profit? Profit is 60 lakh. That is basic earnings by earnings divided by weighted average number of equity shares. Weight not required. In this case, for basic EPS, weight is not required. What is their shares? 20 lakh shares equal to rupees 3 per share. Then they are asking dilutive EPS. Okay. So now the point is, what is the law? Excise date is what actually? 31st March 2014 only. Last date of the year. Last date of the year only they are doing. So we have to identify diluted earnings. Diluted earnings, no change in this question because this is not interest, this is not debenture actually. In debenture we will save some interest, so we have to add here, but here not required. Okay, so 60 lakh divided by what we have to put? We have to calculate the number of shares actually. We have to calculate the number of shares for diluted EPS. Existing shares how much? Existing shares 20 lakh shares, correct? Plus bonus element. Plus bonus element only we have to take it. What is this bonus element share? 4 lakh shares issued. 4 lakh shares issued on what date? 4 lakh shares issued on what date? 31st March only they are issuing. 31st March 2014 only they are issuing. So we need not to give any effect for rights issue because that is last date. Last date of the year, meaning in that year he is not eligible for any earnings. In that year that shareholders does not have any eligible for any earnings because they did not invested at the beginning of the year or middle of the year. They invested at the end of the year. So need not to provide anything for rights portion, but we have to provide for bonus portion because bonus is issued from the accumulated profit. We have to give effect for the current reporting period, even previous reporting period also. So bonus shares. What is the bonus element on this 4 lakh shares? How to identify that? 4 lakh shares is the issues made. What is the what is the price actually? What is the price they made it? Market price is how much? Fair value. Fair value is rupees 25. And issue price is how much? 20. What is the meaning actually? 25 rupees worth of share they are getting at 20 rupees. 25 rupees worth of share they are getting at 20 rupees. Then what we should do? Out of this 4 lakh shares, how much is paid by money, how much is bonus? That we have to divide. Okay. For example, this 4 lakh rupees is for 25. This 4 lakh shares is for 25. Then 20, how much? You got it or what I am saying? This 4 lakh shares is issued for 25 means for 20 how much they will issue? 3,20,000 shares only. Okay, meaning actually they for this 20 rupees money, they are eligible for 3,20,000 rupees only, 3,20,000 shares only, but they are receiving 4 lakh shares. Actually they are eligible to receive only 3,20,000 worth share only, but they are receiving 4 lakh shares. So discount how much? 4,20,000. 4 lakh minus 3,20,000. 4 lakh minus 3 lakh 20,000 equal to 80,000 shares. This is bonus. Okay, this is bonus. Actually this bonus element should be added there. This bonus element should be added there. So what I should do, 60 lakhs divided by 60 lakhs divided by existing shares how much? Existing shares how much? What is the existing shares? Existing shares is 20 lakh. Existing shares is 20 lakh plus 80,000. 20 lakhs plus 80,000, that is 0.8 lakh. Okay, equal to diluted EPS. Equal to diluted EPS. What is the amount? 2.88 per share. Okay, the point is 4 lakh shares is offered to employees, but out of that 4 lakh shares they offered for 20 rupees only. Actual market price is 25 rupees. So actually they for the employee who share the money for that, they will receive only 3,20,000 shares. Extra 80,000 shares is offered by the company as a bonus. That bonus element only added to the denominator. That's why it is presented like that. Here we just go through the answer. Okay, this is the answer. And so I'll give you, for your working, for your understanding, I'll give you this problem. To just go through the problem. Just go through the problem. This is for right shares. Actually this is for right shares. Okay, you should work out the answer. You should work out the answer. Net profit is given. Net profit for 2014-15 is given. Net profit for 15-16 is given. Number of shares before rights issue is given. Rights issue ratio 1 for every 4 is given. The right issue price is given. Date of exercising rights 30th June 2015. That also given. Fully subscribed. Okay. And fair value of shares before rights issue is also given. So you should able to arrive the answer and comment your answer in the you please comment your answer below. I'll confirm whether your answer is correct or not. Okay, and also I will share the answer later. You please go through the question. This is the question. You have to identify the EPS. That is the question. You have to identify the EPS, basic EPS. You have to identify the EPS. That is the question. Okay, please comment your answer in the my channel. Okay. And also one more question, you please take this question also. So this is the question. What will be the answer? On 1st April 2017, Mark Limited acquired Mask Limited by using swap ratio based on EPS of two companies. The earnings after tax of Mark Limited was rupees 2000 lakh and of the Mask and that of Mask was 800 lakhs. What is the EPS after merger if shares outstanding were 200 lakh and 100 lakh of Mark and Mask Limited? So 4 answer is given. You please comment the answer. I will share the right answer at later point of time. Okay. So this way we can interact. This one question I will give you homework and also the second question. This one. This is for identifying the EPS. Okay. And so what is the next one? I think the practical problem is over. The final part is disclosure under AS 20. So when this is applicable, from 1/4/2001 onwards it is applicable, all listed companies, and also it is indirectly applicable to all companies because of schedule 3. In schedule 3 you have basic EPS and diluted EPS, so most all the companies they have to prepare this. See second point. However, under schedule 3 of the Companies Act 2013, every company is required to disclose EPS in accordance with the AS 20. And presentation of EPS is required to be made both on the consolidated financial statement as well as individual financial statement of the parent company. So if I am preparing the consolidation, that is holding company is preparing subsidiaries and they are preparing consolidated, means they have to present two EPS. One is for consolidated financial statement and another one is for the individual financial statement. Both they have to present. And presentation should be in basic and diluted EPS on the face of the P&L account. Income statement they have to present this. Then what is the next one? Both the basic and diluted EPS should be presented with equal prominence for all periods, even if the amounts are negative. Even if it is a loss, company is not earning anything, what I should do? Still we have to present the EPS. Still we have to present the EPS. Okay. What is the next? In addition to above, the following is also disclosed. Numerator, how we calculated the numerator, that is a basic earnings, how we calculated, reconciliation of those numerator, and also weighted average number of equity shares. Weighted average equity number of shares, how we calculated, denominator, that also we have to disclose. Nominal value of shares. So like this, all these items we need to disclose. So with this AS 20 is, I think, examination point of view, this is more adequate. If you have any doubts on this AS 20, you please comment. I'll share we will discuss like this, so that we'll get a better understanding over the subject. Okay, thank you.